Barbara, is that you typing?
Yes, we're starting. We're just waiting for them to start on their end. So we'll begin in just a moment. Everyone's live.
Okay. Okay.
Hello, Jonathan.
Hi.
Hi, this is Bill Pearson up in Anchorage.
Hi, Bill. How is the weather today?
No, it's great. It's beautiful. We have snow. So what we're going to do is we're going to get the meeting started. People are in line getting food. But I just wanted to get you on the line because I know there's people in the webinar. So for the people in the audience here, this is the second Anchorage Estate Planning Council meeting of the year with our guest speaker. We're testing out technology today to see how we can facilitate this with different speakers around the country. And whenever we get a superstar like yourself, Jonathan, we're very grateful to have you here. And it's my understanding that this is, you're doing it on the side with Pioneer Wealth Advisors, it's hosted by the Trust Company, which is formerly Alaska Trust Company, is that correct?
Yeah, that's right, Bill. I think we're going to have over 100 people listening in, which is just great.
Okay, and how's the sound for you right now? You hearing ours okay? Do you have any bad speakers?
Well, there's a lot of background noise where you are, so you're breaking up, and you also sound a little hollow, but that's not so bad. But how do I sound?
A little soft? Okay. Okay, well,
I sound...
line. Okay, well, we'll try to see what we can do to adjust the sound on our side. All right, well, what I'm going to do, though, is just make the introduction, which is pretty straightforward. Are there any guests in the audience today to be announced? Anybody? Okay, well, we're going to get started. I'm just going to let Jonathan start the presentation. The last time he was presenting to the Anchorage Estate Planning Council, I believe he was talking about pigs flying, the Cubs possibly winning the World Series, which looks like it may still be a possibility, and then this newfangled technology called a supercharged credit shelter trust. That was some time ago, but I guess the Cubs are still in place. So, Jonathan, I think nobody really wants to listen to me. Everybody's here to listen to you. So I'm going to hand everything over. At the end of this presentation, if you're online and you'd like a question to ask, it's my understanding I'm going to be repeating it into the microphone. People will type it online. Is that correct?
Barbara, do we know?
Yes, that's correct. Everyone will see the question.
For everybody in the audience, if you have a question, I'll just bring the microphone to you. So with that, Jonathan, let's listen to what you have to say. Thank you.
Right, Bill. During my presentation, which will run maybe 45 minutes or so, it might be good to put your side on mute. And then when I'm done, I'll say I'm done, and you guys can come back online, and questions can be asked, or we'll read them from the teleprompter.
Okay, that sounds real good. We'll do that.
Okay.
Okay, we're going
well, listen, everyone. It's an honor for me to be with you today, and I'm going to cover a topic which is not going to sound that exciting, but it actually really is. In fact, I think it's so important that you will actually begin changing what you do for your clients, both with respect to drafting of trusts and wills, and also with respect to the administration of estates and trusts. What we're going to cover today is some basic rules about the income taxation of estates and trusts, because we're talking about the income tax charitable deduction for estates and trusts. We'll talk about some of the differences between the income tax deductions for individuals on the one side and for estates and trusts on the other. We're going to talk about how the income tax deduction for an estate or a non-grantor trust works. We're going to talk about when it's more efficient to garner that deduction from an estate or trust rather than an individual. We're also going to talk about something that I think very few people have thought about, but it's very important today, which is the dangers of seeking a deduction for a charitable contribution by an estate or trust where that estate or trust has imputed income from a pass-through investment, such as from a hedge fund or a private equity fund. And finally, we're going to talk about why I think you're going to want to authorize charitable contributions in almost every trust you draft, unless authorizing that would cause the trust to lose the tax benefits you're otherwise seeking. For example, you can't authorize distributions to charity for a marital deduction trust. So, Barbara, let's go to our next slide. And I just want to start off by saying that the tax law encourages charitable giving. In fact, almost the entire law encourages charitable giving. For example, there is no state that has a rule against perpetuities for a pure charitable trust. There may be a limitation, as there is under New York law, if you do something like a charitable lead trust. But for a wholly charitable trust, which people often use in lieu of a charitable corporation, there's no rule against perpetuity limitation. Second, charities generally are exempt from income taxes and in many jurisdictions other taxes. Some of them don't have to pay sales taxes on what they sell, and almost always if you have a charitable facility, you don't have to pay real estate taxes. The law also allows the person who makes a contribution to charity to reduce his or her or its taxes because you get a deduction against taxable income for certain contributions to charity. Let me add that these tax rules with respect to charitable contributions are, in my judgment anyway, among the most complicated in the Internal Revenue Code, which we as Americans can be proud is the longest single law in the world. Barbara, let's go forward to our next slide, if we could, and talk a little bit about the taxation of estates and trusts. Congress made a decision a long time ago that rather than having estates and trusts taxed in something way a corporation is or a partnership is, it decided that it would really tax trusts and estates in a manner similar to the income taxation of individuals. However, there are differences, and two of the most important ones are, one, that unlike an individual who cannot shift his or her income to someone else, a trust or estate can shift income because it's allowed a deduction for the distribution of distributable net income, commonly known as D&I, which, as many of you know, is just slightly more complicated than DNA, to a beneficiary. The other difference, there are many, but another big difference, and the one we're going to focus on today, is the allowance of a charitable deduction to an estate or trust as opposed to an individual. Let's go to our next slide, if we could, Barbara. Individuals are entitled to a deduction under Section 170A for contributions of property to charity, but there are a lot of complicated rules and limitations. For example, an individual, no matter how much she contributes to charity, can never reduce her income by more than 20 to 50% of her contribution base, which is pretty close in almost all circumstances to adjusted gross income. So if you're like Beth Chapman and you've got $2 million of income, even if Beth gave $3 million to the Red Cross in cash, she could only reduce her taxable income by half of her income, basically by $1 million, even if she gave $3 million to charity. It's just a rule. However, she can carry the excess forward, subject to the same limitations, and use it over the next 5 years. It also depends upon the type of property that's contributed, whether it's a work of art, whether it's a piece of land, whether it's publicly traded stock. But the contribution doesn't have to be made in order to support a deduction to be made from the taxpayer's income. You've inherited a Picasso, it's worth $15 million, you contribute that to charity, you may be entitled to a $15 million deduction, even though it's never been part of your income. It's just a piece of property. It also depends upon the tax nature of the property. For example, inherent ordinary income or short-term capital gain in an asset is not deductible. So if you bought a stock for $20 and it's risen to $50 and you've held it for less than a year, it's worth $50, you contribute it to charity, everybody knows it's worth $50 because it's a publicly traded stock, but because the inherent $30 gain at that time represents short-term capital gain, there's no deduction. Also for an individual, what kind of deduction you get or whether you get a deduction is dependent upon the type of charitable recipient. You're all familiar that the tax world is broken primarily into two buckets of charities. One are private foundations, normally those that are formed by a family or a closely held group, and the other are publicly traded charities. One thing that isn't very well known is that there's a distinction made in the tax law whether you make the contribution to charity or for the use of charity. Indeed, when you look at 170A, it says an individual is entitled to a deduction for a contribution of property to or for the use of charity. But there are lower limitations if it's for the use of charity. So let's go on, if we may, Barbara, now to our next slide, I guess. No, there are other limitations. There are limitations under Section 170A3, under Section 170F. There are a bunch of those, and they're very complicated rules. Now we can go to our next slide, Barbara. Corporations also get their deduction under Section 170, but they're subject to a somewhat different regime. There's a 10% limitation of their taxable income. For an individual, it generally runs, as I said, between 20 and 50, and also there are a variety of different rules if the person or the taxpayer who's giving it away is a corporation as opposed to an individual. S corporations and partnerships, believe it or not, can make charitable contributions, but if they make a charitable contribution, the deduction passes through to the shareholders of an S corporation or to a partner who is a partner in a partnership or a member of an LLC, which is taxed as a partnership for income tax purposes. Now, if a trust is a partner, and we're going to spend a little more time later about this, the IRS has conceded that the trust gets the deduction. This was conceded in Revenue Ruling 2004-5 after the IRS lost some cases, and the trust will be able to deduct that even if it doesn't meet one of the requirements that a trust normally has, which is that the payment to charity has to be pursuant to the terms of the governing instrument. So if, for example, you have, let's say, a marital deduction trust, and that marital deduction trust is a partner in a partnership, well, you can't authorize that trust to make a contribution to charity. If you do, you're going to lose the marital deduction. But if that marital deduction trust is a partner in a partnership, and the partnership makes a contribution to charity, then there will be a pass out of the deduction to the trust as a partner, and that's a pretty good deal. And that may mean that you want to think about that when you're setting up and funding something like a marital deduction trust or a regular trust, which might not otherwise be allowed to, or which does not provide for the distribution from the trust to a charitable organization. And again, that's very, very important in planning and administering it where the family wants property to go to charity. Or it would be better for the trust to get the charitable deduction rather than an individual. Let's go to our next slide, Barbara, and see what we've got in store now. Individuals get their deduction under Section 170. As a general rule, the trust or decedent's estate is entitled to its deductions under Section 642C. In fact, 642C starts saying, in lieu of the deduction under Section 170A, and then it sets forth that an estate or trust will be entitled to a deduction if it meets the following criteria. The first one is that it has to be paid by a trust, but for a decedent's estate, it only has to be set aside, but it has to be from gross income. Note that it applies even if it's income from a prior year. Now, this might seem, well, gee, this is a good idea. I accumulated income in 2012. I won a deduction in 2016, so I'm going to pay the 2012 income to charity. That works if that income had not previously been expended or hadn't previously been distributed to a beneficiary or to charity. But an individual basically can take any of her property and donate it to charity. It doesn't have to be from income. So if you got that Picasso in 2012, or maybe you had income in 2005, you can pay whatever you want. And again, subject to the complicated rules in Section 170, you get the deduction. For an estate or trust, it has to be paid from gross income, but it can include income from a prior year which hasn't been expended. It has to be paid pursuant to the terms of the governing instrument, and that may seem obvious, but there are some interesting questions about what that means in some contexts, for a charitable purpose. Individuals only get the deduction if they pay it to a charitable organization, but a trust which pays, or an estate which sets aside gross income pursuant to the terms of the governing instrument gets the deduction if it's for a charitable purpose. Now, there is a limitation. Under Section 681, and the first time I read this section, I almost had a heart attack. It said if you're paying the, and Barbara, go down one more click if you would. if you're paying the gross income, which constitutes what's known as unrelated business income, which is essentially like unrelated business taxable income that a corporation or a trust would have. But if you have unrelated business income, income from the operation of a business, or income that otherwise wouldn't be, which wouldn't be unrelated business income, but it's debt finance, then it's going to be unrelated business income. And that puts a limitation on it to 170. So if you have, let's say you have an estate, and the only income the estate has is unrelated business income, because maybe your decedent was a closely held business owner, and all of her income is unrelated business income, you're not going to be able to get a deduction under Section 642C. That's what Section 681 says. You don't get the deduction under 642C. In fact, it says you don't get any deduction at all. But when you wind your way through the code, including Section 512, which deals with unrelated business taxable income, it says you basically get the 170 limitations. So, for example, if you had a charitable lead trust and you were paying the annuity to charity in the year, and you were paying that from, let's say you had $100,000 of gross income, and you're paying, the $100,000 over to charity, you say, I get a $100,000 deduction. If that's unrelated business income, you're going to be limited to the 50% limitation, which is under Section 170. This Section 681 does not apply to a decedent's estate. And one of the things you can do is if you've had a revocable trust, which is acting as the will substitute, and you really don't want to face the 170 limitations, and there are some other reasons why you'd want to avoid Section 170. What you can do is to have the revocable trust make the so-called Section 645 election, which allows that trust for a certain period of time to be treated as part of the decedent's estate for income tax purposes. And now, because if you've made the election, and while it's outstanding, because the former revocable trust will be treated as part of the decedent's estate, you won't have to worry about the limitation under Section 681 for unrelated business income, because Section 681 does not apply to Section 645. Again, the meaning of unrelated business income is essentially the same as unrelated business taxable income, which a charitable corporation would have. It's basically going to be subjected, unrelated business taxable income is subject to the normal corporate tax rates. By the way, if it's a wholly charitable trust, it's going to be subject to the tax as at the individual rates. And that includes business from the income from the operation of a business, even if it passes through a partnership, you go all the way down. And it also includes debt finance property. And one of the things you want to do, and this would come up very frequently in Alaska, where you've had a closely held business owner die, and he or she has been operating through a partnership or an LLC or even a doing business as directly as a proprietorship. If you're going to have funds paid out to charity, you want to make sure that you, as quickly as you can, get rid of that unrelated business taxable income taint. Again, you don't have it during the administration of the decedent's estate, but once the estate is over, you're going to face the problem. Here's one little thing you might think about. If you've made the election under Section 6166 to pay your estate tax essentially over 15 years following death, then the estate will be deemed to be open during the entire 15-year period, plus a little bit more time after that. So you wouldn't have to worry about 681 on income from the operation of the decedent's business if you're going to make payments to charity. And that can be a very good thing. Barbara, let's go to our next slide, please. Barbara? Barbara.
Yes, it's on the next slide. You should be able to see it. Jonathan?
Yeah, what are we doing, Barbara? I don't see it.
Oh, I'm sorry. It's charitable deduction states. It's a state or trust may elect in the current year to treat a distribution of
okay. Yeah, okay. Thank you, Barbara. As I mentioned, an estate or trust can get a deduction even if it pays income from a prior year, but that's no big deal because an individual can take any of her property, whether it's income from a prior year or it's something she's owned forever, and do it. Remember, an estate or trust, it has to be paid from gross income. can be gross income from a prior year, but it does have something else that can be done. It can take income from the prior year, which has not been paid to charity in that prior year, and pay it in the next year, and make an election to treat it as though it was paid in the prior year. So if a trust has income in 2015 and it never paid it to charity, it wasn't paid to charity, but it pays it in 2016, it can elect to pretend as though it was paid in 2015. And this becomes important with something like a charitable lead trust, where you may not know the amount to be paid, or you just can't get around to paying it by the end of the year. Maybe the income, came in at the end of the year, and, you're a trust officer and you want to be on vacation at the end of the year, or whatever it happens to be. Don't worry. You can pay it in 2016, pay that income from 2015 and 2016, but elect to have it treated as though it was paid in the prior year. However, it has to be paid by the time you file the gift tax return for 2015. So now, because we're well into the end of part of October, you couldn't do it. But up until October 15th, the estate or trust could have paid it to charity, or for an estate, set it aside for charity and make the election and pretend as though it was done in the prior year. Individuals don't have this flexibility. If you didn't make your charitable contribution in 2015, and now you're looking at your tax return, let's say it's August 15th, and you say, "Oh my Lord, I can't believe how much income tax I owe. This is like communism. It's so bad. What can I do? Oh, I know what I'll do. I'll give some money to charity now and take a deduction for it last year." Can't do that if you're an individual, but you can do it for an estate of trust by paying the prior year's income in the current year and then electing to treat it as though it was paid in that prior year, if you do it before the income tax return for the estate or trust is due to be filed. And through extensions, of course, that can be up until October 15th. Barbara, let's go to our next slide. I hope it'll come down a little easier. So why would you want to wait and pay the income from a prior year in a later year? Well, one is you simply, as I said, you failed to pay it. Now you wish you had, or you forgot about it. So you have, you've got some coverage. Second is you find out that you had a lot more gross income than you thought. You thought you had $300,000 of gross income in the estate or trust, and it turned out you had more, and you only paid out the $3. Now you find out you wind up getting your K-1s from things, you start getting 1099s, and you realize, oh my Lord, we had so much more income. I wish we had paid that to charity last year so we wouldn't have to pay income tax on this additional gross income we have. Not a problem, again, because you can retroactively elect as long as you pay it by the time the tax return is due to be, the income tax return is due to be filed. The other thing is where you've had low income tax brackets in prior years when the income was earned. So for example, let's suppose you had $10 million of income, gross income, that's what you've got. Maybe you have rental income, but maybe you have losses that are being carried forward from 18 years ago. I know that sounds impossible, but I understand there are people who have these big tax losses that can carry them forward. They have lots of gross income for the year, but they don't pay any income tax. Well, finally, they wind up in a later year, and they've got lots and lots and lots of taxable income, but their losses are gone. What can they do? Well, because those were basically paper losses in the prior year, and it did not reduce gross income which the estate or trust received, the estate or trust could now take that gross income from the prior year, it's not taxable, even though it had no taxable income or little taxable income, and it can pay that gross income in a later year and get a deduction. That is a pretty cool idea. And it would be great if you could do that. And you certainly are going to have some clients who die who you'll start taking depreciation or whatever it is. These are paper losses. They're not using the gross income to, in fact, incur that. So the gross income is not reduced. It's only the taxable income which is reduced. And as long as you can trace it back to the gross income from the prior years, you can pay it in a later year and claim a deduction for it. It's almost like getting a double deduction in some ways. Let's go to our next slide, Barbara, if we could. What are some of the other benefits of Section 642C? You get the same deduction for making a contribution to a private foundation as for a public charity. So, you're limited to basically 20% in some cases if you do cash, 30% for contributions to a private foundation, but you can go up to 50% if it's a public charity, or if you're giving away appreciated property like long-term capital gain publicly traded stock. You give it to a private foundation, you can't reduce your taxable income by more than 30%, but if you give it to a public charity, it's 50%. Well, if you're an estate or trust, you get the same limitations, unless you're under Section 681, which means you're paying it from unrelated business income, in which case you're going to be back to the distinction between private foundations and public charities. One of the things when you're dealing with an individual who wants to create a charitable lead trust, which will not be a grantor trust, it's a separate taxpayer, that individual is going to get the same benefit, and the trust is going to get the same benefit as a general rule, because it's not a grantor trust, whether the distributions are made to his or her private foundation or it's made to a public charity. I want to add a warning footnote here relating to the estate of Charles Revson. Charlie Revson was the founder of Revlon, and Matthew, my nephew Matthew, I think that's the cosmetic line that he uses. Anyway, he was the founder of Revlon, and during his lifetime, he formed two things: a private foundation, and he sat on the board, he was one of the controlling people, and he also created a charitable lead trust. And the charitable lead trust, because it was not a grantor trust, said, pay the annuity over to his private foundation. So he did that. And the trust, as it got income and paid the annuity over to the private foundation, got an income tax deduction under Section 642C. And it had gone very well. They had paid a lot of money to charity. There was a lot of money left that was going to pass to the remainder beneficiaries, but then Charlie died. And the IRS came in and said the entire trust was includable in his estate. And Charlie's lawyer said, no, you don't understand. We made a gift up front. We filed a gift tax return. Yes, we zeroed out the value of the taxable portion because it was deemed all to go to charity, so you can't collect any tax. The IRS said wrong. Because the charitable lead trust was paying money over to a foundation, and Charlie could control what happened to the annuity payments that came in, Charlie had retained a power under Section 2036A2 and Section 2038 to control the beneficial enjoyment of the property coming out of the charitable lead trust, and therefore the charitable lead trust was fully includable in his estate. Because at the time that Charlie died, there wasn't much left to be paid to charity, there was a huge amount of estate tax, which is the state owed, because it was about $50 million in the charitable lead trust, but only 10 qualified for the charitable deduction by that time because the rest had been paid out to charity, so that he had to pay estate tax on the $40 million difference. Those are not the exact numbers, but that's the thrust of what happened. So make sure, if you're paying it over to the private foundation, that the private foundation adopts a resolution, and the IRS has approved this in private letter rulings, that the creator of the charitable lead trust, you ought to do the same for a charitable remainder trust, may never participate in the disposition of the annuity or any other payment from the charitable lead trust or the charitable remainder trust over to that foundation. And if that's a resolution which the board adopts, then you shouldn't have to worry about estate tax inclusion, even though it's going to his favorite charity. An alternative might be to say let's say Beth Chapman again created the charitable lead trust, and she'd have one of her sons or her husband choose the charities, and that should work to avoid the inclusion. But you should always have your foundations adopt a resolution saying that any money that comes in from someone through a charitable lead trust or charitable remainder trust, the person, the donor, cannot participate in the disposition of those funds. Something that's not well known is that individuals are only entitled to an income tax deduction for contributions to U.S. charities. So if you have a client, for example, who wants to give a donation to the International Red Cross, that's great. And by the way, contributions to foreign charities aren't subject to gift tax, but you don't get an income tax deduction. Now, what Americans do to avoid that adverse effect is they have an American organization that's going to give its money over to that foreign charity. For example, John McCloy wanted to make contributions to the Hague Academy, which, as you know, tries bad people in this world. So the Hague Academy wanted to get money from John McCloy, who had been Deputy Secretary of War during World War II, but he couldn't give it directly. He wanted the deduction. So I formed for him something called the Friends of the Hague Academy. That was an American organization which was going to give all of its assets over to the Hague Academy in Holland. It was a Dutch charity. And because it went to the Friends of the Hague Academy rather than directly to the Hague Academy, John McCloy got his deduction. For an estate or trust, however, you get the same deduction whether it's going to a U.S. charity or a foreign one. There's no distinction. In addition, as I mentioned earlier, you get a deduction not just paying it over to a charitable organization, which is the only way an individual can, but for a charitable purpose. That would mean, in theory, that the trust could carry out its own charitable program directly. It could foster amateur sports competition. It could provide education or some sort of scholarship grants. It could also, do alms for the poor directly rather than through another organization. The parameters of what charitable purpose means in the context of a payment of gross income being paid for a charitable purpose isn't clear. So if you have a client who wants to do it on her own, I would strongly recommend you get a ruling from the Internal Revenue Service. And here's another nice one. Every month a case comes down where some taxpayer is denied her income tax deduction because she didn't meet the substantiation requirements. Getting the thing back from the charitable organization or otherwise. Remember, that applies to any non-cash gift worth $250 or more. And a lot of people blow that and they make a mistake, but an estate or trust apparently doesn't have it. So especially where you're going to make a payment over to charity, you don't have to get a receipt. And indeed, if you get a ruling from the IRS that you can carry out the payments through a charitable purpose as opposed to a charitable organization, it's nice to know you have no substantiation requirements as individuals do. Why no substantiation requirement? Because the substantiation requirement is under Section 170. And unless you have unrelated business income, it means you're going to be under Section 642C, where there is no substantiation requirements. Let's go on, Barbara, and see some of the other potential benefits. Well, let's take a look. As I mentioned, it's got to be gross income paid for a charitable purpose pursuant to the terms of the governing instrument. Now, the Old Colony Trust, which was decided by the Supreme Court, says the payments don't have to be mandated. They can be discretionary payments of gross income. That's okay. But you can only get the deduction if the payments are really authorized. There was a case involving Leicester Crown, from which some of you will remember we used to tell our clients to do so-called Crown loans, which were interest-free loans payable on demand, and the argument was there was no gift. The Supreme Court held there was a gift, and then we got Section 7872, which basically adopted statutory rules. But Mr. Crown also created a charitable lead trust. And one year they had more income than the amount of the annuity, which is a potential problem for a charitable lead trust because now you're going to have to pay income tax on that excess income. And that doesn't make people very happy you pay that income. So what the trustees of Mr. Crown's charitable lead trust did is they said, we're going to pay charity now annuity payments that are due in the future. And they calculated them correctly, but the tax court said, nope, no deduction for the Crown Charitable Lead Trust because those payments were not authorized. They were one way or the other, and as a consequence, even though they were going to be made in the future, the way they were paid, that was not permitted, and therefore there was no 642C deduction permitted. There's a very recent case, just came out last week, called the Hubble Trust, where the court said even though for years the trustees had been making payments to charity because they thought they were authorized to make payments to charity, the court said no. The instrument does not authorize the payments, even though you made them, and even though nobody complained in the past, you get no deduction. So you've got to be sure that the payments are authorized. Even if you make a payment to charity, if it's not authorized, no deduction for you. Now, you need to show some positive intent by the grantor, and the Brownstone case is a very interesting one. Mr. Brownstone left when he died all of his estate in a old-style marital deduction trust for his wife, a trust where she got all the income, but she also had a general testamentary power of appointment. It's a trust under Section 2056B5. All income to Mrs. Brownstone, and she had a general testamentary power of appointment. And Mrs. Brownstone exercised that power of appointment in favor of her estate. She said, have all the property in this marital deduction trust when I die paid over to my estate, and she left her estate 100% to charity. So the trustees of this former marital deduction trust, which was still in existence, as it earned income, said that this income is going to be set aside for charity because all this income is going to go to Mrs. Brownstone's own estate, and her estate is going to charity. But the tax court and the circuit court said, no way, Jose. Unfortunately, it had to be Mr. Brownstone's intent that it go to charity, not Mrs. Brownstone. It will not work because she was not basically the grantor. The funds were attributable back to Mr. Brownstone, and because he didn't have the sufficient positive intent to make the payment over to charity, they would not allow the deduction for it. Now, there were a couple of things that could have happened here in Brownstone, and maybe someday you'll face this because you'll have a couple which doesn't have kids, or their kids aren't deserving and they want it all to go to charity. What should have happened is that Mr. Brownstone's estate should have made a distribution to Mr. Brownstone's trust, the marital deduction trust, former marital deduction trust, should have paid its income over to Mrs. Brownstone's estate. Presumably, that would be deemed to consist of distributable net income and would have shifted the income from the former marital deduction trust over to Mrs. Brownstone's estate, and that would make it gross income to Mrs. Brownstone's estate, and it would have been set aside for charity. I don't even know if they tried to argue that, but that's what they should have done. The other thing they might have done is to perhaps decant the trust over to another trust. And so if you have a trust which doesn't have the requisite intent, let's say I have a trust for my son, John, which doesn't have any charitable intent, but in the one that I do for my son, Jeff, I authorize distributions to charity. Any income in Jeff's trust which is paid to charity is going to qualify for the 642C deduction because that's what the Old Colony case from the Supreme Court says. If it's authorized, it's enough. Suppose we now decant the trust for John, which doesn't say anything about charity, and pay its assets over to the trust for Jeff. Will that work? Well, I think there's a good chance it should work because it's the same grantor in both cases. I'm the grantor. But suppose one trust was created by my wife for John, no charitable intent, and I do the one for Jeff, and then we decant the trust my wife created for John over to the one for my son Jeff. Will it qualify? We just don't know. What would be better, and this is at the bottom of the screen, cut off a little bit, is Revenue Ruling 2004-5. 2004-5 would say, even though the trust for John doesn't have the requisite charitable intent, if the assets in that trust was placed into a partnership, and that partnership was authorized to make the charitable contribution, and it did so, that deduction would flow out to the trust as a partner, and that's under Revenue Ruling 2004-5. Now, by the way, there's a lot of law as to whether or not when a trust makes a contribution to charity, whether it's treated as actually being made by the partnership or not. You should explicitly authorize the partnership to make charitable contributions, and that way you can be sure the partnership gets the charitable deduction, and under the partnership rules, it will flow out to the partners, which in this case would include the trust for my son John. Let's go to our next slide, Barbara, please. It's got to also be paid from gross income, and believe it or not, there's got to be some tracing. You just can't say, well, we had $150,000 of income, we paid $150,000 of property over to charity, and therefore we get $150,000 642C deduction. Well, there's a problem, And that comes about in a number of cases, but one of my favorites is the estate of Sid Richardson. Sid Richardson was a wealthy Texas oil man, and he operated his oil company through an S corporation. And obviously, he was the shareholder of it. The income was imputed to him, and he had to pay income tax on it. When he died, he left his entire estate over to charity. And even in those days, there was a rule that a decedent's estate was an eligible S shareholder, so it's not a problem. Mr. Richardson dies, the S corporation continues as an S corporation because Mr. Richardson's estate was an eligible S shareholder. In those days, trust couldn't be, but even since 1958, when the subchapter S rules came into effect, a decedent's estate, as long as it doesn't last for more than a reasonable period of time to administer the estate, is a good S shareholder. So there's millions and millions and millions of dollars of income, which the S corporation is now earning after Mr. Richardson died. That income is now attributed to Mr. Richardson's estate as the sole shareholder. And the estate is taking a set-aside deduction. So it gets a K1, let's say, for $15 million or $25 million or $40 million or $6 million, whatever it is. The estate is getting the K1 exclusively, and the entire estate goes to charity. IRS comes in and says, no deduction. And they said, what do you mean no deduction? Everything has to go to charity. They said, look, you had imputed income because you did not physically receive that income. It could not have been set aside for charity. Wow. Think about that. It's all eventually going to go to charity, even if it's not distributed. It would be inherent in the corporation. All the stock of which was passing to charity would probably be sold. But they said no deduction. And there are other cases as well that you've got to actually trace that income. Now, there is a favorable case out there that just came down a couple of years ago called the Green case. In the Green case, an LLC actually made the contributions to charity. The LLC got income, and rather than distributing it right away to charity, the trust actually, the LLC actually bought buildings with it. So the LLC, which is owned by the trust, it goes ahead and it buys property which appreciates in value. And then the LLC made the contribution basically on behalf of the trust, which was the member of the LLC. It wasn't a disregarded entity, but it actually made the contributions to a bunch of charitable organizations. And the IRS initially didn't want to allow the deduction, but it conceded, yes, the LLC is like a partnership, and because the partnership was making the charitable contribution, it flows out to the trust as the partner. But the IRS said it's limited to the amount of gross income. They bought these buildings for $15 million. Now they're worth $20. The trust is seeking a deduction for $20 million, not the $15 of gross income. The court said, this is a federal district court in Oklahoma, said you get the deduction for the entire $20 million, not just the $15 million of gross income which was used to buy the building. One of the important points here is that when you have gross income, if you can trace it that you bought another asset with that gross income, then that asset remains gross income for purposes of Section 642C. That's a very good deal. By the way, they got the deduction of 20. Now, you might say, this is fantastic. What I'm always going to do is I'm going to have the estate or trust take its gross income and invest it, and then when we distribute that stock or that building or whatever we bought with the gross income, we'll get a bigger deduction. And that is true under the Green case if the property has gone up in value. But what if it's gone down in value? Suppose the building, which the LLC, which was owned by the trust, suppose the LLC bought a building for $15 million, it went down to 12. Well, then when it gave the $12 million out to charity, it probably would have only gotten a $12 million deduction. So thinking about reinvesting it may make sense, but remember, if it goes down in value, you're going to be limited probably to the fair market value. If it goes up, you presumably under the Green case, it goes up, but I wouldn't count on that. Now, you might compare this rule of tracing to the distribution of distributable net income to beneficiaries. Basically, subject to a few exceptions, no matter what you give a non-charitable beneficiary, it's going to be deemed to consist of D&I. Even if you give something, let's say there was a boat in the estate or trust, and you give the boat to the beneficiary, it's clearly not income. But under the rules of 651 and 652 and 661 and 662, that vote will be deemed to consist of the estate or trust distributable net income. There is no tracing requirement at all as a general rule. But for a transfer to charity under Section 642C, you've got to prove that it was from gross income, and you better be able to trace it. And we're going to come into a problem here in just a minute. The distributions to charity, there's a long history of this. The courts have never allowed a distribution to charity to be deemed to consist of distributable net income. A distribution to a charitable remainder trust or charitable lead trust, because it's not charitable, probably it will be deemed to consist of distributable net income. In fact, I got a private ruling to that effect. And note that D&I is in gross income. So if you have income in the estate or trust, it's being paid to a charitable lead trust. Decedent dies, he's got income in his estate, that they're making payments to the charitable lead trust to fund it. The D&I is going to be shifted from the estate over to the charitable lead trust, and that will be gross income in the charitable lead trust. And the charitable lead trust, as long as it can trace it, now can go ahead and pay it out to charity and get a 642C deduction. So that's good news, but you've got to be very, very careful in the administration of it. How about pass-through investments? Well, I've got a trust, and we invest in things like hedge funds and private equity, or maybe our client, for example, had a partnership, and we're getting lots and lots of K1s, and we're being told we have this income. But just like Sid Richardson, if you do not receive that gross income, you will not be able to be deemed to have set it aside or pay it to charity, even if you make a payment of cash over to it. So your client was, in the construction business, which continued after she died, and you get a K1 saying that you've got $150,000 from the operation of the business for the past year. Okay, you say this is great. I can retroactively take a deduction. I'm going to pay $150,000 over to charity, and you do that. Well, the problem is, unless you can show you got a distribution from the partnership, from his construction company, you can't prove that you paid the $150,000 of imputed gross income you have. You may have $150,000 of cash, but you've got to show it's cash from that entity that you got it from, and that's a real problem where you have something like a passive investment, like a hedge fund. What can you do? Well, here's what I've done. I have the trust form a new partnership. Yeah, it could be in the form of an LLC, but have it taxed as a partnership. So my trust, which wants the deduction and is willing to pay to charity, but is not going to receive a distribution from the hedge fund equal to the gross income shown on the K1 that the trust is getting, I go ahead and I form a new partnership. And rather than having my trust make the investment in these pass-through investments like a hedge fund, I have the partnership make the investment in the pass-through investments. That means my partnership is now going to get the K1. And what it's going to do is it's going to send a K1 to me. So my partnership, owned by the trust that wants the charitable deduction, makes the investment in the pass-through investment. It's going to get a K1. But that partnership, of which the trust is the partner, is going to receive from this partnership not just a K1, but it's also going to receive a distribution of cash, which the general partner will label as gross income from operations. And that should mean that you can now trace it. The trust says we had gross income not from these pass-through investments, which the partnership made, but from this partnership itself. And it made a distribution to me of, it told me, $150,000 of gross income. I cannot guarantee that that works. I think it works. I've done it. I haven't been challenged. And I don't know of any other solution you can do other than saying that we're not going to allow the trust to make investments in pass-through entities like a hedge fund, like private equity or something else, where you have income imputed, but you do not receive a concomitant distribution of cash. So that's a problem which you'll face. It's also important for a decedent's estate because of Sid Richardson. You've got to show that what you are claiming the deduction for, you actually receive that gross income, and you either, if it's a decedent's estate, set it aside, put it in a separate bank account, trace it to other investments, or you paid it over to charity and you can trace it from the paying entity, like this intermediate partnership. It received gross income, it put it in a separate bank account or brokerage account, and then paid charity from that separate bank account or brokerage account. That's how strict I think you've got to be if you don't want a problem. Barbara, let's go on. Let's see what else we have for our friends. We're back to unrelated business taxable income in Section 642C. Section 681 says no 642C deduction to the extent the gross income consists of unrelated business income. You're thrown into Section 170. And you've got it here. Now, this is kind of interesting. About 5 years ago, the IRS changed the rules. The rule had been that when you made a payment of gross income to charity, you could say what gross income you were paying. So if you had, for example, interest income and capital gain, or business income and dividends, you could say, I'm going to pay charity from this higher type of taxable income. I'm going to pay it from the interest income or the business income rather than from dividends or from capital gain or from even tax-exempt income, and that worked. But about 5 years ago, the IRS changed the rule, and there's the regulation under Section 642C, which says, nope, it's going to be proportionate unless you have a significant economic effect. So if you say pay charity only the short-term capital gain, and that's what you do, that'll be okay. But you can't say, well, we're paying this, and we're going to deem it to consist of the short-term capital gain first. It's going to be from all classes of gross income. Now, that regulation does not, by its terms, apply for purposes of Section 681. So I believe that you may be able, if you have unrelated business taxable income, to show that you made the distribution to charity other than out of the unrelated business income. So if you had $100,000 of unrelated business income and you had $100,000 of non-unrelated business income, just regular gross income, and you paid $125,000 to charity, you could, I believe, say $100,000 was from the income which was not unrelated business income, and only $25,000 was from the unrelated business income. This is a rule which you need to be aware of, because very often the clients you have, when they die, are going to wind up with business interests which produce unrelated business income. Doesn't come through a corporation unless it's debt finance, but where you have a partnership or an LLC, you may have it, and you need to be aware of this rule. Application where we have the partnership, where Revenue Ruling 2004-5 says if the partnership makes a distribution, it's treated as though we still get a 642C deduction for charity, for the trust, or the decedent's estate, even though the trust or the will or the trust is silent with respect to making payments to charity. And the IRS has indicated that even though you don't have to prove it was pursuant to the terms of the governing instrument, the trust partner still gets the deduction. They've indicated you have to still reduce the deduction by the 681 provisions if you're paying out what would have been unrelated business income. That's what the service has stated. I'm not sure the service is right. I would certainly take a contrary position on a tax return, although I might disclose it to make sure I wasn't penalized for it. Barbara, let's go on, if we could, to our very next slide. Partial interest rules. Remember, Section 170 is this terribly complicated provision, and one of the things it has is that if you give a partial interest to charity, not 100% of what you own, you get no deduction. And Barbara, are you still there? Because my screen has just died.
Yes, I'm here.
No cable connected. Well, this is kind of bad, but yes, this is kind of bad. I hope nobody else has gone blank, but
No.
I've gone back here. But I think I can finish up on this slide. I know it so well. An individual gets a deduction for remainder interest in a trust only if it's in the form of a charitable remainder trust, which means it has to pay an annuity or a unitrust amount. If you want to get a deduction for the lead interest, it's got to be in the form of an annuity or a unitrust payment described in Section 170F2B. Those sections, the 170F provisions which deal with partial interests, do not apply to Section 642C. So if the trust authorized the creation of a charitable remainder trust or a charitable lead trust, and you did it with gross income, you wouldn't have to meet all the requirements, for example, of a charitable remainder trust under Section 664 or for a charitable lead trust under Section 170 F2B. And that provides additional, a lot of additional flexibility. So that's something you might keep in mind in planning. I don't know how much it's going to do you today, because if you're just paying income, it's only going to be valued this month or next month at 1.6% a year. But if interest rates went way up, as they were when the 75-20 rates first came out, they were 11%. Wow. Katie barred the door. You can create a charitable remainder trust and pay out the income, and you'll be deemed to pay out 11%, which might not be so good, but for a charitable lead trust, it would be fantastic. And you don't have to meet the at least 5% payment test and the 10% actuarial value with the remainder for a charitable remainder trust, or any of those gnarly rules, because Section 1, those rules are basically contained in Section 170, not in Section 642C. Barbara, I can't see it, but what is our next slide?
Other considerations. So states.
Oh, yes, states. Not in Alaska, at least today, until we get an income tax, but in other states, the states often begin to be very miserly with respect to the allowance of a charitable deduction. In some states, like California and New York, you get a lot of income, they reduce or they eliminate your charitable deduction. Those rules do not apply to a charitable, to an estate or trust getting a deduction under Section 642C. What's next, Barbara? Section 68?
Tier 1 distributions in Section 642C.
Yeah, this is a little complicated, but let me say the following. You should never mandate the payment of gross income from a trust unless it's required in order to get the tax benefits, as it is for a marital deduction trust. You've got to do it for a marital deduction trust because the law says that you have to. Diana, would you come here, please? Get my laptop. The screen has gone blank. You should never do it. One, you got flexibility. The income interest, believe it or not, in some cases can be attachable, but this is a minor point, but here's the deal. If you have a trust that is required to pay all of its income currently to someone, as many trusts do, and the trust is permitted to and makes a deduction for to charity, and it's entitled to a 642C deduction, it will not reduce the amount of distributable net income. So, for example, let's say you have a trust for my daughter. She's got all the accounting income, and the accounting income, let's say, is $100,000. And yet the trust authorizes the trustee to pay capital gain to charity. Well, that's in payment of gross income pursuant to the terms of the governing instrument. So the trustee pays $50,000 of the capital gain over to charity. My daughter, because she's entitled to all of the income from the trust, income in a trust accounting sense, she's going to still have to pick up $100,000 of income because her D&I doesn't get the benefit of the 642C deduction. If it was a discretionary payment to my daughter and the trustee still gave her $100,000, her D&I would only be $50,000. So that's something you need to consider. Another advantage is the net investment taxable income thing we have under Section 1411. This is sometimes known as the Obamacare tax, where you pay that extra 3.8%. You're a big income tax payer like Rich Hompish. Rich has lots of income. He's got lots of net investment income. He wants to pay money to charity and reduce the amount of income tax and net investment income tax he pays. Sorry, Rich. You as an individual get no benefit for net investment income tax purposes, the Obamacare tax, for making payments to charity. But trusts and estates do. So when you think about making distributions to beneficiary, you better check to see if they're going to be subject to the net investment income tax, and if they are, if they'd like to block it by making a contribution to charity. They can't block it if they make the contribution to charity themselves. So it may be better for the trust to make it on their behalf. In addition, you avoid the 3% cutback under Section 68. Section 68 basically says once your income gets above a certain level, I forget exactly what it is, but it's like 175,000, we begin to cut back your itemized deductions by 3% of the amount by which your adjusted gross income exceeds that threshold. And if you're in a state like Alaska where you pay no state income tax, you're going to lose the benefit of at least a portion, if not all, of your charitable deduction. But the 3% cutback does not apply if the contribution is made of gross income of the estate or trust over to charity. What this means is that you should almost always authorize the distribution of gross income to charity unless the trust would be disqualified. It's an authorization. It's not a requirement. Barbara, I know there's one other line which talks about checks and balances, but you have to build in a check and balance in my judgment. Don't say, well, the oldest child can make distributions to charity because maybe he'll make distributions to charity so his brothers and sisters won't get distributions, or he's taken over by some weird charitable group. And again, it's a charitable purpose, so you have this weird kind of arguably charitable thing. I won't mention any names, but you can think of some that your family probably wouldn't want to go. So always have a check and balance. Say, yeah, you can pay it over to charity with the consent of the trustee. Similarly, don't let the trustee do it without the consent of at least one family member, so you'll have an appropriate check and balance. And Barbara, let's go down now to, I think it'll be, yeah, here's another one. This is kind of interesting. There have been a lot of incomplete gift trusts created in Alaska. These are trusts, transfers to which are not subject to gift tax, but the trust is not a grantor trust. That might sound impossible. They're known as Ing Trust, Ding in Delaware, Ning in Nevada, a King in Alaska. But they're used primarily to avoid state income tax. So somebody in California, for example, creates an Alaska Ing Trust, a King Trust. The transfer to it isn't a completed gift. The trust is not a grantor trust. As long as it's not a distribution, the trust is separately taxed and it's not subject to California tax. A very, very good result. New York has tried to block that, by the way, but it's the only state that's done it. But it will allow an individual who, for example, wants to make additional contributions to her foundation, or wants to avoid the partial interest rules, or wants to avoid the substantiation rules, to create such a trust, not to avoid state income tax, but to be able to switch from Section 170 to Section 642C. And there may be even an Alaskan that wants that to happen. So that makes some very, very good sense. But there's likely to be very, very limited benefit if we have unrelated business taxable income. Barbara, let's go to our next slide, please. And now we're going to have a little summary. In order to get a deduction under Section 642C, it's got to be gross income, and there may be a tracing requirement, paid to charity or for an estate set aside for charity. Remember, there may be tracing requirements pursuant to the terms of the governing instrument for a charitable purpose. We don't face the adjusted gross income limitations like we do for individuals, except for unrelated business income. We don't have any partial interest rules except for unrelated business income. We don't face a Section 68 cutback of the deduction, and we also get the benefit of the deduction for the net investment income tax, and we can avoid state reduction for the deduction. And I think you should consider authorizing distributions to charity in every trust you do, unless the trust would lose a tax benefit, as a Q-tip trust would, whenever you're doing it. Again, build in those checks and balances between the trustee and the beneficiary, so neither can act alone. And keep in mind Revenue Ruling 2004-5, which is the one that says a trust, even if it does not authorize the distribution of gross income to charity, nonetheless will be entitled to a 642C deduction to the extent that a partner of which the trust is a partnership makes a charitable contribution. Well, friends, that's it. I think we've run a little bit over time. Barbara, do you want to open it up for questions?
Yes, I'm going to have Matt unmuted on their line. In the meanwhile, I have a couple from folks that are watching online. One of them is, I have a new client named Ralph who died recently at the age of 92. His desire was to donate all of his assets to 6 charities in the church, etc. He has a few assets in his revocable living trust, stocks and bonds and brokerages. Um, those assets are liquidated at modest gain and will go to charities. He has a lot of commercial annuities with his estate named as the beneficiary. Um, and there are substantial embedded deferred income that will be 1099, but the annuity companies to the estate as part of the total cash payout. His read is that the estate will have to pay the full income tax on the income for the payout, but the DOD value of the annuity is considered principal. So there's virtually no deduction for then remitting the money to the 6 charities. His question is, does the trustee have to make sure it holds back the income tax owed on the estate income tax return before it considers the payout to the charities?
Well, again, because you have an estate, you're entitled to a set-aside deduction. All you're going to have to make sure of is that if you have some income imputed to the estate, that you receive a concomitant distribution of cash. For example, on the annuities, you're going to have imputed income, that's for sure, but make sure you get an adequate distribution under those annuities, and now you should get a set-aside deduction for it. Similarly, if you sold property at a gain, even if you had something like 691 income, income in respect of a decedent, as long as you get a physical receipt for the amount of income imputed, you should get a 642C deduction. If worse comes to worse, if you're really worried about it, maybe you want to think about forming a partnership and have the partnership make the distributions to charity. Let's take our next question, Barbara.
Okay, how do health and education exclusion trusts work as vehicles to avoid GST and allow non-income beneficiaries access to income and assets for other than H&E? What's the minimum amount of income that needs to be distributed to charities annually?
Well, there's no answer to that question. There is a rule for generation skipping transfer tax purposes that if you have a charity in there for purposes of avoiding the generation skipping transfer tax, then you're not going to be able to have that beneficiary considered as a beneficiary for generation skipping transfer tax purposes. So if you've got a trust where you have, let's take an extreme case, you have $1,000 a year paid out of that trust to charity, and you say, as beneficiaries die off and you otherwise would have a generation skipping event to occur, because say the children all die, we postpone it because charity is still in there, and charity is considered to be of the grantor's generation. But I very much worry as to whether or not that's going to work. It's not so much that you can't get the exclusion when you pay for health and education for the beneficiary, but especially in the regulations, it says if a purpose of having charity in there is to avoid the generation skipping transfer tax or to postpone the generation skipping tax, that beneficiary will be ignored. What I've told people who've tried to do this, have at least a significant uni-trust amount each year, maybe 3, maybe 5% a year paid out. That's pretty high. Most families aren't going to do that. Could you say, well, pay 50% of the income? Maybe that would work, but there is virtually no developed law in this area, and I think that there are probably better ways to avoid generation skipping tax than one of these health and education trusts which has charity involved in it. Next question, Barbara.
We have a couple, but I think that you've covered most of them. If folks have additional questions that we haven't gotten to, I think we're going to have to get to them directly, Jonathan, after the fact, because we're 15 minutes over and the live event, folks have to get back to work, and I'm sure you've got other things to do. So we appreciate your time.
Barbara, I have to go to the airport.
I know, I knew that. I didn't want to say it. All right.
Well, I do. Well, listen, thanks, everybody. I know. Look, I'm going to guess that most people on this call haven't really thought about these. I didn't either. About a year ago, I began to look at this in more detail. As some of you know, I write a book with Professor Ladd Boyle on the income taxation of estates and trusts. And let me mention that a copy of that book, given as any sort of gift, whether it's an anniversary, a Christmas present, a bar mitzvah, whatever it is the most thoughtful gift you can give. But I began to look at this and realize there are real advantages by working that 642C deduction into play. So if you hadn't thought about it before, you're joining me, because up until about a year ago when I began to write on this, I hadn't thought much about it either. So thank you all very much for listening. And Matthew, I will call you later. And Barbara, thank you so much for your help.
Of course, everyone. Have a great day. Thank you.